Welcome, everyone, to Daily Mortgage Rates Live with the Mortgage Calculator. We are going to pull some live rates today and go into a deep dive as well on the loan type. So we will get started here in just a few minutes. In the meantime, we do have the chat up, so feel free to drop a comment there in the chat as well while we wait to get started. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us just a minute to go live on all the different platforms, and then we will get it started here. But thank you, everybody that was already tuning in early, dropping comments. We appreciate it. We'll get started here in just a moment. Thank you, Warren, Malik, Dario, Adam, Julio, everybody dropping comments. We appreciate the support. Harriet, thank you for tuning in, dropping a comment. And it looks like we are good to go. So we can go ahead and get started here. We are live on all the different platforms. So let's get into it. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every day on this show is go through actual live mortgage rates for different programs. And then we do a deep dive into a different loan topic. And today's topic is going to be 5 to 8 unit property loans. Now, because we specialize in non-QM here at the Mortgage Calculator, we're very familiar with this program. One of our most popular requests here is the 5 to 8 unit property loans that we do. And so our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to do a deep dive into that topic and pull up some actual rates for those type of loans. But before we do that, we will get into our regular agenda here by pulling up rates for some different programs. So Nick, let's go ahead and pull up our pricing tool and see what the market is actually looking like this morning.
All right, let me switch my screen and we will get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and APR, including all the fees. For today, it is August 7th, just after 11 a.m. Eastern, so most of our standard programs are live with new rates for the week. And if you'd like a full loan estimate with all of the itemized fees broken down, please get with one of our loan officers. We have over 300 licensed loan officers in 24 states for primary and second homes. And we can do our DSCR business purpose loan, like our topic for today, to 5 to 8 unit properties in 44 different states. So please get with our team members if you'd like a full breakdown. For our demo today, we will set up a basic scenario so that we can compare apples to apples across the programs using the same exact setup. So we'll set a loan amount of $400,000. We will set the LTV to 80% loan, 20% down payment. We will set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in cost, which is our typical request these days. And we're going to compare our loan programs. We will first check out our conforming conventional programs. Then we'll compare that with our FHA rates this morning. And then we will check out some expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternate income. We don't do VA live. That's only for our active or our eligible active service members and veterans. If you are eligible, let us know. We'd be happy to quote it. And we do a couple shows last week on the different variations of these programs. But since not everybody is eligible, we don't do it live. And same with USDA. That's only for properties that are eligible. So later this week, we will have a deeper dive into some USDA programs, but we don't do that on our live rate show because it's only for eligible properties. So for today, we'll start with conforming conventional. For all our demos, we'll set up a purchase, 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos today, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with these basic settings, let's check out the conventional rates. All right, good. Looks like it relaxed just a little bit. It's right about the same, but 7.125 rate, 0.875 discount points at cost. Final APR, 7.287, just over 7. So these conventional rates have been reacting with some market news. So if for any reason our customer can't qualify for conventional, for any reason, typically the next option that we'll compare here is an FHA program. So if we set up the same exact scenario, this time we will choose FHA. Everything else will stay exactly the same, so we can compare APR across the different programs. And let's see what the FHA programs have today. Remember, FHA does allow a little more leniency on credit events, as well as a higher debt to income ratio. So it's usually the next option here. Now, the best option the computer found today, 6.5 rate, 0.625 discount points and costs. Final APR just a touch over 7 at 7.080. So in this example, if our customer qualifies for both conforming and FHA might be a touch cheaper. In this example, it's about 0.2 cheaper overall with the APR when we compare across programs. And remember, the APR does include the upfront mortgage insurance and yearly mortgage insurance for FHA. So this is a great option for our borrowers that qualify for both. Definitely check it out. And our borrowers that need to use FHA for the DTI or credit issues that they may be facing. This is a great news for us as the FHA rates have included some recent changes to the MI. Now, where we love to specialize here at the Mortgage Calculator is if our customer, for any reason, doesn't qualify for either of these more standard programs. Many other banks or lenders can't help, but that's where we really specialize here. So we'll set up the same scenario, and this time we'll choose expanded guidelines, also known as non-QM. So everything will stay exactly the same, but with non-QM, we have a new option pop up. That is our income option. So full doc is what we use for conventional and FHA. That's 2 years of tax returns, what most people are used to. So we'll typically choose a non-QM program to take advantage of one of these other options, such as asset-related options, business bank statement options, our investor DSCR options, which we're going to go over here in a minute. Personal bank statement 12-month is our most popular program by far, so that will be the one we select for our demo. We also have RSU, stated income, VOE, 1099, P&L, and CDFI no ratio. But for today and our demo, as we do every day, we will choose our most popular option, which is the personal bank statement 12-month for our self-employed borrowers looking for a primary home option. So with this option, instead of 2 years of tax returns, we will simply use their last 12 months of bank statements to determine a debt to income ratio of 40% in this example, using no tax returns involved at all, just the last 12 bank statements only, using their cash in the bank. So most of our self-employed borrowers will qualify for double, triple, or even more income, and therefore may qualify whether they wouldn't qualify at all before, or may qualify for more income, and therefore get that dream home they really want. So these non-QM programs are amazing solutions for our borrowers who might need a little bit of extra help. So let's check out the bank statement options this morning. So we love when these are very comparable here. 7.25 rate, 2.375 discount points and costs, so a little more cost, but our final APR here of 7.362. So almost identical to conventional today, where we can use bank statements, which would obviously allow us to qualify for more income and solve those problems. We also have tons of other options here. If we scroll down here, we'll see other bank statement options. Some of these are a little bit higher rate, may allow things like foreclosures and bankruptcies and other types of credit events that would otherwise disqualify us from FHA or conventional programs. So not only can we solve the income issue here that our borrowers may have, but we may also solve some other problems to qualify our borrowers. So we love these programs. Please get with our team member. They will find which one of the hundreds versions of these bank statement options will work best for you. Now, for our final couple demos, we always want to do some live pricing for investment properties. So we'll set up the same exact scenario, 80 LTV, 20% down payment, and we'll simply compare our two options for investment properties. We have conforming conventional options, and we'll have our non-QM options. Remember, the government programs, FHA, VA, and USDA do not apply for investment properties, so we'll simply compare these two. So we'll keep everything else the same. Notice the only thing we've edited here is the occupancy to investment property. So let's see what adjustments the conventional programs have added for investments. It's a little bit lower than it was last week, just a touch. So 7.5 rate, 3.375 discount points and costs, puts our final APR at 7.746. So this is just a touch lower than it was last week, so that's good. But many of our investors would like other options. So unfortunately, there are no one discount point options here. This lowest option is 3.375 discount points and costs, which in this example is $13,500, Most investors request to go higher in the rate as long as the property cash flows in order to reduce these discount points. $13,000 is a lot of money. Most investors would rather spend elsewhere. So unfortunately, conventional programs do not have any options. That's where we love to present our final demo here. Set up the same scenario, and we're going to choose our investment property, expanded guidelines, also known as non-QM options. So the first thing we must select here is our income verification. And the most popular option by far is our DSCR program. And that's because it doesn't require any income or employment from our borrower. We simply use the estimated rental income from the property we're purchasing in this example to determine a DSCR, stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage that we're proposing, that's a ratio of 1.00 or higher, aka in simple terms, the property cash flows on a monthly basis. If the property does not cash flow on a monthly basis, that is a ratio under 1.00, and we still have options for that. But for the demo today, we will always put 1.5, so that will show us all the different programs since that's the highest value we have. And the final thing we need to select is a prepayment penalty. We will always select 3 years because that is standard. There are options for 0 prepayment penalty that will cost a little more and limit the loan programs. And same with 5 years. Not all loan programs allow 5 years, but when we do have those options, it does save our borrower a little bit of money. However, the most common is 3 years, so that's what we always use for our demo here. So with these basic settings, let's check out the DSCR options this morning. So best option here at the top, 8.125 rate, 0.725 discount points and costs, puts our final APR at 8.182. So we solved our problem for our investor here. Instead of $13,000 here, nice, easy to handle $2,900. And it has a higher rate. Most investors are happy with these options as long as their property cash flows. So most investors, when presented with a DSCR non-QM option compared to a conventional option, will choose the DSCR option. I'd say 90% or more of our investors right now are typically leaning towards the DSCR option. And if we scroll down, we'll see dozens of different options here. Some of these at a little bit higher rates may allow things like bankruptcies and foreclosures, as we mentioned before, and some may even allow short-term rental income. And as a segue into our next segment here, some of these DSCR programs are so special that they allow properties that would otherwise disqualify from a standard loan. So let me go ahead and switch my screens, and we will talk about what that really means here with Jose's example today. So today, our topic for our deep dive is going to be on our 5 to 8 unit properties. These are traditionally commercial properties, right? A 5 to 8 unit, anything over 4 units is technically a commercial property, but these are small residential, quote unquote, commercial properties. So we have some loan programs that kind of weave between the lines here of what is traditionally acceptable. And we're able to use our DSCR programs. You just saw a couple of those options do allow us to apply the same program that we would use for a 1 to 4 unit property and using a simple DSCR ratio to do a small commercial 5 to 8 unit residential property. We also have mixed use as well. So I know Jose might throw that in there as well, but that's not necessarily the topic for today. But Jose, if you want to go ahead and explain a little bit more detail of the examples we have, let's go ahead and check it out.
Good morning, everybody. Thank you for joining us. Daily Rates Live with the Mortgage Calculator. I guess first I'd like to give a little bit more detail on our product type, right? This is for a mixed use product where you have a residential component. That is the most important thing to note from here is that there is a residential component to this situation here that has to be at least 50%. So at least 50% of the structural component has to be residential. This is not a pure commercial product that would be like, 3 professional offices and 3 retail offices, for example. You do have to have at least 50% of it has to be residential. Now, with that being said, we have really good rates for this product compared to what you're going to get in the commercial realm. In the commercial realm, you're usually going to get probably 11%, 12% for this type of property. Uh, Here in ours, as you're going to see, we have pretty good options for purchases as well as for refis. However, on the refi component, it is a little bit more restrictive when it is a refi versus a purchase. In this product, on a purchase, we can go as low as 660 at a I think it's 65% LTV with a 660 or above, which is pretty good. Versus on the refi, they're really only going to let you go down to a 700 credit score. So it's, they really do want to help you out on the purchase, but on the refi, you're really going to have to jump through some hoops of fire here. So let me just make sure I got my entries here correct before I share with you. I did have a typo a second here. Let me just preview this. All right. Okay. So let me share my first option with you, which is for a 5 to 8 unit purchase. This is our best case scenario, right? 760 or above.
Is this mixed use or 100% residential?
This is only the residential mixed use component. Not, I mean, excuse me, what I'm talking about mixed. This is the 5 to 8 unit, not the mixed use. I was getting thrown off there with the question. So this is our 5 to 8 unit, which does have better pricing than the mixed use. And our 5 to 8 unit DSCR pricing has pricing comparable to 1 to 4 unit, and in many cases is more competitive pricing than what you're going to see out there in the 1 to 4 units, right? So here you're looking at 8.25% is your lowest cost option, and look at the cost on that, very little cost, and you can buy it down to 7.875 and probably even a little bit lower, right? So I just wanted to show stuff that I could guarantee was in compliance. But if we were to run the 5% test, I think we could probably run it a little bit lower than 7.875. Right. So now I'm going to the worst case scenario, which is 660 or above. Now, the LTV here actually does drop to 65%. So our loan amount there should not be 375; it should be 325. But the interest rates are correct at 8.75 as our lowest cost option and 8.5% as our lowest rate option. Now you will see that it is quite a bit of a jump there, but then again, we are dropping down to 65% LTV and we're dropping down to 660 credit score. Right. So now we have our refi, cash out refi at the 760 or above credit score. So this is our best case scenario cash out refi, and it is at a 70%, not 75%. But the interest rates are correct. 8.75 is your lowest cost option, and 8.5% is your lowest rate option. And then I have here scenario for our 660 cash out, 700 cash out at a 65% LTV. So 700 is the lowest FICO score for the cash out. Keep that in mind because they do let us go down to a 660 for the purchase, but 700 is the lowest for our best case scenario rate option. We do have other rate options that are higher that will go to a lower credit score. But for this preferred option, which you can see are very good rates, this is the lowest credit score that they will go. So you have 9.375 with a little bit of a lender credit, and you can take it down to 8.25%. So again, that is 700 credit score, 65% LTV. So as you were noting here, I mean, in our first example here, you're looking at rates that are going to beat many of the 1 to 4 unit DSCR rates out there. And again, to put it into context, the rates that you're going to see in most of the competition out there on this 5 to 8 unit residential component product is going to be definitely higher than 8.25%. I'd probably say they're going to be somewhere around 11% for somebody with this credit score. So you can see why this program is so exciting for us and why we do so well with it. As soon as we send these quotes out to the investors, they get very excited and they're ready to jump right into the application.
All right. Looks like we have a question here if you want to take that question here, Nick. The question is, I just took a HELOC of $295,000 from a property that I'm renting. I'm buying a condo for kids going to university. What is your best advice? Should I pay off the condo for $270,000 or should I give 20% down and invest more in real estate properties? I guess what would be your advice there?
It says I already have 2 other properties. I also have a residential property. So that's the rest of the question there.
Yeah, I guess what would be your advice there, Jose?
Well, I mean, I guess it depends how expensive that schooling is, right? And what's the interest rates on the student loans if they were to have to get student loans, right? It's tough to answer it without knowing the rest of the information. But what I would say is that they're creating more wealth when they're investing, right? And you would then hope that the future appreciation of that property will pay off those student loans as well as the cash flow that they're going to make on these properties, as opposed to deferred interest expense on student loans. So, you know.
It doesn't say anything about student loans. It's just asking if they should use financing or not, is the question.
Okay. Well, I mean, I was just looking at the kids going into university because I just had mine finished there. So, I would keep investing in the properties. It's you're definitely going to be making money in the long term there.
Yeah, no, me and Nick's philosophy is definitely leverage, right? So we would definitely put that into more properties as opposed to paying one off. But I guess it's just more of a personal preference there. All right. I don't see any other questions, so I think we can wrap it up here. Remember, we do this show every day, every weekday, 11 a.m. Eastern time, where we go through the live rates and then do a different deep dive as well into a different topic like we did with the 5 to 8 units today. If you want to connect with one of our loan officers, you can visit us at themortgagecalculator.com. We can pair you up with one of our 350 loan officers all across the country that can consult you through these different programs. Thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Rates Live with the Mortgage Calculator. Everyone, take care. Have a great day.
Thanks, everybody.